Hey guys, hope you're all having a great day. Today, I'm going to be going into a brief analysis of Disney stock and my outlook on the company. For those of you who don't know what Disney does, the company focuses on entertaining, informing, and inspiring people around the globe through storytelling, iconic brands, creative minds, and innovative technologies. In other words, the company is much more than just several theme parks and iconic characters. Now, of course, due to their business model being hurt due to the Rona outbreak, the stock is down 30% from its recent highs. This has made their financial ratios look very attractive to a variety of investors. In terms of financials, the company is trading at a PE of just under 20, has a book value of a whopping $50 a share, and has a price to sales ratio of under 3. I believe these financials are actually quite deceiving to many investors, and most do not understand the immense risk of buying Disney stock at its current share price. Let's make something clear though. I am not bearish Disney. However, in this video, I'll be explaining why I am not buying Disney stock and what price it would need to fall up to in order for me to be comfortable investing in it. At the present stock price, I believe Disney stock will most likely underperform the market for years to come, and I will elaborate as to why there's a good chance that my thesis will come to fruition. First, let's go over Disney's four main sources of income. The largest of these revenue sources comes from their parks and consumer experiences. Pretty much all of their income coming from this section has evaporated due to the lockdowns that are occurring worldwide. Most investors are quite aware of the fact that parks and ships are not set to reopen for a while. I believe parks need to stay closed for many more months to prevent a second wave of Rona from occurring. Even if they do reopen this year, demand will not even be close to what it once was when the parks all reopened. Former CEO Bob Iger suggested that when parks reopen, they won't be at max capacity and many rides, meet and greets, as well as events will not be taking place upon reopening. Keep in mind, the company could be losing tons of money if these parks aren't running at full capacity. On top of this, the rides at the parks and their cruise ships are at very high maintenance levels, and employees of the company are quite nervous that a lot of the complicated rides will take months to ensure that they meet safety standards. In short, the longevity of the shutdown, coupled with the lack of demand upon eventual reopening alone, is enough for investors to question the mere 30% reduction in share price that we're seeing now. Disney's second largest source of income is from media networks. Of that, their largest revenue gains specifically are from ESPN, a sports broadcasting platform which has no sports to broadcast at the moment and would definitely see a loss in subscriptions and revenue as a result. In the future, a lot of these subscription cable-based broadcasting sites that Disney owns will definitely be threatened by much cheaper online subscription platforms. I believe, on a conservative basis, this section will only see a quarter of their revenue cut in the next 6 months, but it could be much larger than that. Next, at 15% of the company's revenue, we have studio networks. Sure, brands such as Marvel and Pixar create some of the most beloved movies in the world, but Disney will not see much revenue from box office screenings in the next year. Disney will most likely take a loss, producing and delaying some of these beloved films. As demand for physical theater screenings slowly continues to decrease, this section of revenue might never recover to what it once was before the outbreak. The last section of Disney's revenue includes advertising and Disney Plus, their newest streaming platform. I'll just focus on Disney Plus within this section, as many are expecting the platform to be as big as Netflix in the near future, and the reason that Disney stock is trading so high. The company has amassed 30 million subscribers in a matter of months, which is quite remarkable. My only concern with the streaming service is that right now, the company has invested so much money into the platform that on the bottom line, they've actually been losing money. Cutting costs on the platform will definitely not be an easy task for Disney, given their relatively large budget for box office screenings. Now, sure, around 70% of Disney's revenue will be cut for about a year. Big deal, they're going to be bailed out anyway, worst case scenario. Plus, they're a world-class company beloved by all. Well, let me get into their absolutely atrocious balance sheet and show you why this company could have overextended themselves to potential bankruptcy. Right before this outbreak occurred, Disney added $40 billion onto their already high levels of debt to acquire the media network 21st Century Fox. This was already concerning investors, but of course, The markets are looking very healthy, and with the new launch of Disney Plus, most believe the increase in revenue would easily cover the debt. Before the virus, the company had over $31 billion worth of short-term debt in comparison to $28 billion worth of short-term assets. To me, even before this whole crisis, that's a very concerning sign considering their net income for 2019 was only $11 billion. The company has actually added over $6 billion to the short-term debt, which I expect to rise in the coming months. If that wasn't enough, the company has well over $80 billion in long-term debt, which will only rise as time goes on. This is very concerning considering most of their long-term assets consist of goodwill and intangible assets, which most investors, such as myself, consider to be a phony category. Plus, they have physical properties where their parks are located, in which they can't liquidate. So basically, they can't liquidate any of their long-term assets and will need to rely purely on the revenue that they generate to pay off that debt. Even if Disney Plus actually earns money, it will likely not be enough to pay off their massive amounts of short and long-term debt. In fact, even if net income came back to that $11 billion level in 2021, it would take the company years to pay off their short-term and long-term debt obligations. This not only jeopardizes their dividend for years to come, but also any and all growth that the company has planned within the next 5 years or so. Lastly, I don't trust management at the moment whatsoever. Bob Iger, the former CEO, just stepped down right before the Rona outbreak to protect his legacy. He appointed Bob Chapek CEO, but recently Iger has actually returned to save the company. Here's my problem with this. While I have no doubt Bob Iger will likely do everything in his power to prevent Disney from going bankrupt, Bob has already sealed his legacy and won't be held accountable if he isn't able to save Disney. In fact, no one on management will be held accountable if the company suffers for years to come. Additionally, while this stock has provided investors with very nice returns, Bob Iger has ultimately grown Disney to a point in which I believe it is simply not sustainable. And while I do believe in Disney long term, I think that the company will continue to disappoint investors with poor earnings per share and overall performance for years to come. As a result, I'd only be a buyer of the company if the share price fell over 35% from where it is currently. That's going to wrap up my thoughts and analysis on Disney stock and why I don't believe the risk return trade off is worth it at all at their current share price. If you enjoyed, be sure to like and sub to support my channel, and as always, have a wonderful day.